This video is brought to you by Knowledge at the Australian School of Business. For more information, please visit knowledge.asb.unsw.edu.au.
Earthquakes in New Zealand, flooding in Victoria and storms in Sydney all highlight the substantial economic impact of catastrophe events and the importance of the international reinsurance market. This is where one insurance company insures itself against huge losses resulting from a major catastrophe. But the potential for huge losses is more than the insurance market could bear if, in theory, all of these claims come at once. To spread the risks, the insurance and financial markets are starting to intersect with ever more complicated financial derivatives. Dr. Morton Lane is the president of Lane Financial, based in Chicago. He's also the author of Alternative Risk Strategies. He's here at the Australian School of Business to present a series of seminars on financial derivatives. So Dr. Morton Lane, these type of catastrophic events seem to be becoming ever more common. Is the insurance industry as a whole worried?
Well, first of all, I'd question whether or not they're coming more frequently. Some people think that they are because they're recent, but we have long stretches where there are no events. And if you average them out over time, the frequency tends to be quite stable. Unfortunately, they cluster, and we seem to be having a cluster at the moment, but it doesn't necessarily mean there's a trend. It just means we have a cluster at the moment.
Okay, so it's just a perception because these type of events by their very nature are very dramatic. But if we've got a cluster, how does the insurance industry cope with having so many of them all bundled up together?
Well, the insurance industry is capitalized in such a way that it can meet catastrophes and absorb catastrophic losses for a 1 in 250-year event. That's a very rare event, and we haven't seen one of those in quite some time. The biggest one we saw was in 2005, which was Hurricane Katrina, and that was closer to a 1 in 70-year event. If you include the losses from Katrina, which were about $40 billion, and you add the other hurricanes that took place that year, Rita and Wilma, the industry suffered a loss of $85 billion. And it recapitalized itself within about 12 months. So the industry is quite capable of absorbing big losses, and it positions itself in such a way that it can do that.
But there is this question of the economy taking a massive hit. Insurance companies obviously paying out to actually reconstruct the buildings and so on. But is there a case of maybe the economy can get a boost from this type of reconstruction? I'm thinking of maybe the recent earthquake in New Zealand, where a lot of insurance capital is going to be going in to rebuild these buildings. There's almost going to be a little bit of a building boom going on, as we've seen in other places where there's been a similar event.
There certainly can be a boost to the economy that otherwise, if you didn't have the insurance policy proceeds, the economy would suffer. Once you've got the proceeds from insurance coverage, then you can replace existing assets and houses, and that can provide a boost to employment and a boost to material buyers and so forth.
But the insurance companies, of course, they're going to be taking that hit. They're going to be moving, depending on their reinsurance. That's obviously where other companies will insure these companies for the catastrophic losses that they will take.
Well, there is a chain of risk transfer. When you buy an insurance policy, for your house, you are transferring the risk to the insurance company. The insurance company, if it gets too many of those policies in one area, passes those to a reinsurance company. And there may be a third and fourth step along there. But along that chain, each type of company is trying to manage its risk. So reinsurance is part of that mechanism for managing the risk. And in the last decade or so, we've also seen a new mechanism for transferring the risk, and that is the introduction of catastrophe bonds, where the risk is transferred into the capital markets. So not only do the insurance companies move it to traditional reinsurers, but they can move it to the capital markets as well.
And this must be what you're looking at as your Director of Financial Engineering at the University of Illinois.
It's one of the things that we look at Illinois.
So what have you actually found post the global financial crisis? Now we seem to be coming out of the stage where the whole credit market seized up and where it was very difficult to get capital. Is it getting harder for reinsurance companies to get hold of the cash?
It was hard for everybody to get hold of the cash during the financial crisis. But in fact, insurance companies did extraordinarily well. And it was not because of the insurance risks that they'd taken on that some of their values dropped. It was because of the assets on their books dropped in value, as they did for every other financial participant. So when the assets recovered, so did the insurance companies. One other thing is that during that crisis, these catastrophe bonds that I had mentioned as a way of transferring risk to the capital markets did extraordinarily well. They lost less in value than any other asset that was being sold in those dark days of October and November of 2008. They traded at prices in the 90s, whereas most securities, fixed income securities, traded in the 60s and the 40s and the 20s. So the bottom line is that these new instruments that some people were afraid of proved themselves quite well during the financial crisis. And the issuance of these has begun to pick up as it did immediately after Katrina. It's picked up again and seems to be going from strength to strength.
But why are the catastrophe bonds so popular? Why do people prefer these bonds as opposed to, well, other types, government bonds?
Well, not everybody prefers them, but enough people like them because they are diversifying risks. If Chairman Bernanke decides to tighten credit, all bonds will go down in price, and stocks may suffer as well. But a catastrophe bond that's linked to hurricanes is not going to be affected by the interest rates. And so they are a diversifying asset that you can put into your portfolio, and everybody wants diversification in their portfolio.
But at the same point, surely if people are investing in these bonds, people must be worried if there are a series of hurricanes, and surely the value of these bonds goes down.
If there are hurricanes, you will lose money on the bonds. If you bought General Motors bonds, you lost money on General Motors because they didn't do very well. So when you buy a bond or any asset, there is a risk associated with it. The question is that risk correlated with all the other risks I'm taking? And catastrophe risk is an uncorrelated asset.
But at the same point, we are talking about risk, and we're talking about areas that insurance companies traditionally weren't in. After all, traditionally, people would insure their house against it burning down, and then you could see the risk being moved on. Now it's moving on to bonds, ever more complicated financial instruments. Is there a nature that by moving the risk around in this area, it becomes just more obscure, less transparent, and so inherently more risky?
Just by moving it, it doesn't become more risky. It is the same risk. It's just that somebody else has taken it on. And the insurance business has been around at least for 350 years. And one of the traditional places that risks were moved was from insurance companies to Lloyd's. Lloyd's of London has a long reputation of absorbing difficult risk. And so this is an additional tool to traditional reinsurance, Lloyd's of London, and now you have catastrophe bonds, which are going directly to the capital markets.
But surely we have to recognise that the risk stops somewhere. After all, if we look at the example of Lloyd's and the traditional names of Lloyd's, that was where the risk traditionally stopped, of the old families of England, if you like. Suddenly we saw these names incurring huge losses 20, 25 years or so ago. Many of them had to sell off the family lands, the stately home, and they ended up virtually bankrupt. So again, isn't there a danger here that eventually the risk will stop? People may lose money.
Well, what you say is correct. The people who underwrote the risk in Lloyd's a few decades ago actually lost a lot of money. The people who bought the policies never lost 1 cent. And so the people who are asking for protection, which is what you do when you buy an insurance policy, were very glad to be able to collect on that protection. And that would be true of catastrophe bonds as well. The money to secure that protection promise is put into a trust. And certainly the people who put the money in the trust, the people who buy the bonds, may ultimately lose. But the people who wanted the protection, who bought the policies, will be very glad to know that there is money there to pay them off. And so you have to take two sides of these things. We don't destroy risk, we move it to people who can absorb it.
And I'm sure those people who are, say, suffering because of an earthquake, a storm, a flood, whatever it may be, they'll actually be very grateful to have that risk. But how can you get people to invest in those bonds if people realise, by their very nature, eventually they might actually have to end up paying up?
Well, they are prepared to take a certain price. Go back to General Motors. You can lose money in any financial instrument, in any bond. And the reason that you buy bonds in General Motors is because you think the reward you're going to get is commensurate with the risk you're taking. And so it is with catastrophe bonds too. The reward you get for buying these bonds is commensurate with the risk you're taking. So that's why people buy it, just as they would with any other investment.
Dr. Morton Lane, thank you very much.
A pleasure.
For more business news and analysis from Knowledge at the Australian School of Business, please visit knowledge.asb.unsw.edu.au.